How's that now? There we go. That should now work. Let me know if that's all right. No, there's a little bit of delay on the stream as well. So I'm going to wait until I get a positive you can hear me. As you should be able to now. All good. Perfect. All right. Okay, cool. Guys, so let's start again. You saw the thumbnail. Okay, so I did a live on IG earlier this evening, and I had a question about the US markets. The US markets have been in green over the last 4 weeks. And I wanted to talk a little bit about that because I think when you're investing, particularly if you're kind of like new to investing, it's very, very easy to not be able to control the monkey on your back, which is telling you to react on news based on what's going on at the time. So, what I want to do is I'll just walk you through a few things that I think are really, really important, and hopefully, will give you an insight, not necessarily to answer the question of whether or not the US market is in recovery, but to give you some context around what has actually happened over the last 4 weeks. So let me just grab the screens that I was going to share here again. Is that the right one? It's this one right here. Okay, so this is this is on investing.com. So this is the markets as they performed today. All right. So you can see that the Nifty 50 is up, the Hang Seng is up, and the S&P ASX is also up. But let's have a look at the major US markets. So the S&P 500, the Nasdaq 100, and then within that you've got the Dow Jones as well. They're all down today. Now, if you zoom back out and just go for a weekly view, you'll find that actually the Dow Jones up 2.36%, the S&P 500 up 1.89%, the Nasdaq up 1.23. When you go back over a month, actually not bad, 14.02% for the Nasdaq, S&P 500 11.98, so almost 12%. The Dow Jones 9.73. Now, you may think, well, actually, this is really, really good news because you know what? We're in recovery territory. Stocks and markets should continue to basically just continue to grow, right? That's the sentiment. At least that's what you would think. But I think it's really, really important. This is good news. And if you're investing, you've been sat in the market, you would have seen a sea of red up until now, pretty much, really. So it's important that we take the good with the bad and we acknowledge what's happened over the last 4 weeks. Me personally, I've got money in the S&P 500, and over the past probably 3 to 4 months or so, it's been down. Lost money. I think at the peak it was at 9% down, roughly. I looked last week; it was in positive territory by about 1.5%. So you got to. It swings and roundabouts, right? We all know this as investors. But the real point here is why? Why are we seeing the markets do this within over the last 4 weeks? That's the big question, and it comes down to the inflation numbers over in the States. So if you look at the inflation numbers in January, 7.5% was the inflation rate in January. And what we've seen is a steady increase in those interest rates up until the point where we got to what? That was June, 9.1%. And remember, during this period of time, the Fed have been increasing the rates every single month or every other month as they've met through the year, to the point that you've now got interest rates in the States at the highest they've been for a very, very long time, similar to where we are currently in the UK. Now, why over the last 4 weeks have we seen a reduction in, number one, the inflation rate? Because this is the July number, 8.5%, so down from 9.1% to a 0.6% reduction. And how is this reduction giving confidence to the point where you start to see this kind of performance? Well, to answer that question, Michael Blurry. So if you've watched the film The Big Short, if you haven't, you should definitely go and watch it. It is an amazing, amazing film. So Christian Bale plays Michael Burry, who is effectively, he's a fund manager. And it's an amazing film. If you go and watch that film, you have a really good understanding of how the 2007, 2008 market crash came to be. But anyway, this is what Michael Blurry, he sounded a warning last week, warning about, the collapse of the market, so on and so forth. And he's had some very interesting things to say over the last 24 months. If you're not following him on Twitter, you really, really should. So let me just jump in here. So they're looking at why the markets have been in positive territory over the last 4 weeks. So it says here, the main financial indices closed on August the 12th for the fourth consecutive week in the green. And by the way, this article is on the 13th of August, so it's about 4 days old, right? So it says here the S&P 500, the benchmark, rose by 134 points, 3.3%. The Dow Jones was up 957 points, which was 2.9, and the Nasdaq 389 points, or 3.1%. The reason for this euphoria is that investors are now convinced that the Federal Reserve will probably be less aggressive in its policy of raising rates to fight inflation, which is at an almost 40-year high. So, as a result of inflation numbers coming down from 9.1 to 8.5% in July, there is now a lot of confidence in the market, which resulted in the numbers that we saw over the last 4 weeks in the US market specifically. Now, I did do a video a couple of weeks ago, maybe a week ago or so. I talked about the S&P 500 and the FTSE and the fact that the FTSE's held up really, really well. Now, the S&P 500 is obviously a much, much larger kind of like market with a lot of tech companies in there, a lot of sectors. We don't necessarily have that tech exposure here in the UK, but that's a really interesting video in terms of the conversation around diversification and building portfolios, which we'll probably come onto a little bit in a moment. So bearing in mind, that was the sentiment that we read. This is from 4 days ago. What's actually happened today? So this article is from literally today, 2:09 Eastern time. And it says here, Fed members back faster rate hikes to tame inflation, Fed minute shows. So these will be minutes from one of their meetings, which get released retrospectively, sorry. And it actually says here, in light of the elevated inflation and the upside risk to the outlook for inflation, participants remarked that moving to a restrictive stance of the policy rate in the near term would also be appropriate from a risk management perspective, because it would better position the committee to raise policy rates further to appropriately restrictive levels if inflation were to run higher than expected. The Fed's minute showed, it says here. So participants judged that a significant risk facing the committee was that elevated inflation could become entrenched if the public began to question the committee's resolve to adjust the stance of policy sufficiently. Now, the Fed have been they've been criticized for being slow. The language they use about inflation, and I spoke about this probably in December, January, February, maybe even in March this year, it was transitory. It wasn't going to be here for long. It will be gone. It's just a momentary thing because of bottlenecks, because of obviously COVID. Byproducts of that, right? That hasn't turned out to be true. So they had to move very, very swiftly with interest rate changes to the point where now we've got interest rates to the point where they are in the United States. So this came out today. And let me just remind you of what the markets have done today as a result of that. The markets are essentially down. So the Nasdaq, the S&P 500, and the Dow Jones are all down. Now, why is this important? I alluded to this a little bit earlier on. If you're investing, the news is important so you can stay abreast with what's going on. However, one of the biggest challenges most investors face is the fact that when they hear a piece of news like this, there almost feels like there has to be an urge to react, putting more money into the markets, or when markets are down, should I get money out? It's really, really important to be able to control the monkey on your back when it comes to the news. The news is great for keeping up to date, for knowing what's going on at any given time. But you need to try and control how that makes you react to your investment portfolios. Now, I've said it a lot of times on this channel. As long as you know what your goal is, your investment time horizon, we know that the markets will go up and down. And that leads us to the question of recession. Now, I did a video with Wealthify where I had their CIO and CEO talk about this. And the general thought out there is that there is likely going to be a recession, likely being the operative word, because all the indicators are telling us that a recession is due. And we've been saying this for years now. And I say that to say this. If you're invested at the moment, it's going to be a bumpy ride and you need to be prepared for that. But is the US market in recovery? Well, for the last 4 weeks, it felt like it. Moving forward, I don't know. I think you need to be prepared for volatility. The fact that if the Fed does increase interest rates again when they meet in the future, shortly, in a few weeks, actually, what are they going to do? Are they going to increase the rate by 0.75 again? Or are they going to maybe taper back and increase it by 0.5%? We don't know these kind of things. The market will react accordingly to those. So now it's really, really important that you hone into your timeline, your goal, why you're investing, making sure you got good diversification within your portfolio to make sure that, yes, you're able to cope with what's going on now, but more crucially, your portfolio is positioned in the best position possible for the future, because this is what it's all about, right? We're investing for the future. Now, interestingly, I mean, recession and that word recession, I don't know whether you actually keep track of what a recession is, but it feels like they've actually changed the definition of what a recession is. And I do want to show you something, because for the longest time of me being in the industry, this has always been the standard definition of a recession to my understanding. Okay. So a period of temporary economic decline during which trade and industrial activity are reduced, generally identified by a fall in GDP in two successive quarters. Two successive quarters. Now, I couldn't believe it when I actually saw this online. But if you go on Wikipedia, and it used to give the exact same definition on Wikipedia, it no longer actually says within two successive quarters. It just doesn't say that anywhere. And even if you go onto Investopedia, it doesn't anymore. So, I mean, it's interesting, and there's a lot of conspiracy theories out there around, why would they do that, and they want to change the perception of what it is for public confidence. I don't want to get into conspiracy theories or anything like that, but I thought that was a really, really interesting thing that I've noticed from watching, and I had to verify it myself. And there we go. It is changed apparently on Wikipedia. But guys, please be careful if you're investing at the moment. Try and keep your wits about you. Try and stay calm. There will be a lot of volatility moving forward. That issue comes with the territory, right? The key thing here is: are you invested in a diverse way? Do you know what your timeline is? What your goals are? Are you invested accordingly? Have you overextended yourself? Are you able to get yourself into a better position from a portfolio build point of view? Those are the key questions to essentially ask. Second time lucky, Darth Mike, 15% inflation projected for the UK, Europe having massive inflation. Maybe we in Europe are just ahead of what's to come for America. I don't think we are, mate. I think the situation that they're facing in the States is very, very different to ours in the UK. I've got a video coming out on Tuesday next week where I speak to a couple of Americans, and their inflation is very, very different to ours. Our inflation is driven by energy costs, food cost predominantly, fuel cost as well, but mainly energy cost. And that isn't a supply versus demand issue. So when you increase interest rates, it encourages, when you increase the interest rate, what it should do is encourage people to save more, which reduces the supply of money in the economy, in circulation, which then brings down prices. What we have here, and that's simple supply versus demand, what we have here is a huge demand for energy, but the supply chain is so small. That is what's pushing our inflation numbers really, really high. I've said it for months. The Bank of England increase in interest rates is not going to work, and it hasn't worked thus far. 13% is the forecast for October. And even some of the professionals are saying that the Bank of England are grossly underestimating the impact of the energy prices on the inflation number come October. So it will be interesting to see where we are. At the moment, we're in August, there's 2 months to go. If the inflation number goes up again in September, and we're at 11%, and I did a live this afternoon talking about, we're at 10.1% inflation right now. It's scary. In the States, they are able to produce, they've got production, they've got oil, they can do all of that onshore in the States if they wanted to. And that's what they're pushing for. What they have seen is they've seen the cost of a gallon of petrol or diesel increase quite a bit, but they haven't had anywhere near the amount of inflationary pressures from energy prices over in the States. That's just not the reality for them there. So to a certain extent, their interest rate hikes have worked. Ours haven't, because we're facing a completely different issue. And there we go. So can't have a recession with a midterm elections in the US. Well, look, the Biden administration are in a little bit of a mess at the moment, but there we go. Anyway, I wanted to do this because I was looking at this last week and I didn't have time to do the video, and I'm away from Friday for a week. I've got a video scheduled for Tuesday, and I wanted to speak about this because it's actually quite personal and it's quite important for now. I hope you enjoyed it. If you are just watching this, you're not subscribed, do consider subscribing, but I appreciate you guys. We did it the second time round. Thank you for sticking with me.